Wealth creation and management of securities. So in this introduction, what we are going to do is we are going to go through wealth creation through investments in securities by way of security analysis and portfolio creation and management. But in this session, we will only deal with security analysis. We will briefly go through security analysis, which involves fundamental analysis, technical analysis, market efficiency analysis. In fundamental analysis, we actually have economy analysis, industry analysis, and company analysis. After security analysis, securities are brought from markets, which are primary market or secondary market or stock exchanges. We will briefly go through what is risk and return from investments. We will also see minimization of risk and maximization of return by CAPM and APT. Only introduction to that. The details or detailed discussions we will have in a separate session. So first, wealth creation through investments in securities. So for wealth creation through investments in securities, there exist two phases of wealth creation, namely security analysis and portfolio creation and management. By way of security analysis, what gets selected are securities that have a good potential for growth. Security analysis may also involve many different types of analysis. We have gone over that, which are fundamental analysis, technical analysis, and market efficiency analysis. Now, after security analysis, the securities are brought from the securities market, which may be primary market and secondary market or the stock exchange. These investments in securities are supposed to fetch returns in the future. But since there is an element of uncertainty in any future dealings, there is surely a great amount of risk inherent in any investments in securities. In other words, any investments in securities invite returns from such investments as well as risks inherent in such investments. Wealth creation mandates the investor by properly investing in securities should minimize risk and maximize returns. So, one of the methods, so you know that there is risk and returns from investments. We have to minimize risk and maximize returns. So one of the methods of minimizing risk is diversification of investments, made possible by the creation of a portfolio for the numerous securities that are bought by the investors. The portfolio of investments comprise of different securities, and the investors, by designing an optimal portfolio, will surely minimize risk and maximize returns. An alternate risk minimization method is using derivative instruments like forward, future, option, and swap. The risk involved in trading assets for investment purposes are also hedged by the use of derivative instruments, which is another way to minimize risk. So you have to see sessions on how to minimize risk by using derivative instrument or by using derivative instruments as hedging instruments, which is again another way to minimize risk. Now, for maximizing returns by evaluating a portfolio, there are two methods, namely capital asset pricing model or the CAPM and the arbitrage pricing theory, which helps in the estimation of the expected return of a portfolio, which makes sure portfolio management is a success based on any such estimations. So in other words, it is rare to find investors investing their entire savings in a single security. They tend to invest in a group of security called portfolio, which is nothing but a name given to a group of securities that the investor invests their money in. So next, we will see portfolio management. What are the different phases of portfolio management? One is security analysis. That is what we will go a little bit in detail in this session. The others are portfolio analysis, portfolio selection, portfolio revision, and portfolio evaluation. These we will discuss it in a separate session. Now, what is security analysis? So the first thing which we are going to do is we will explain what is security analysis, and then we will explain the approaches in security analysis. So first, what is or explain security analysis. Buying and selling of securities are part of investments in securities. Accordingly, the investor can invest in the primary market is where the investors directly purchase the securities from the company that is issuing its securities. And from the secondary market is where the investors purchase and sell securities issued by companies that get traded in the stock market or the secondary market. Usually, the stock exchanges provide liquidity to the investments made by the investors in the corporate and industrial sectors. In addition to providing liquidity to the industrial sectors, the stock exchanges also provide valuation of the stocks that gets traded in them. Now, the National Stock Exchange and Mumbai Stock Exchange are the major national stock exchanges in India, and in addition, there are several regional stock exchanges in India. The regulator of these stock exchanges is SEBI, or Securities and Exchange Board of India, which is also the regulator for primary and secondary markets. Various types of securities are available to the investor to invest in. To get a faint idea, in India, shares of about 7,000 companies are listed in the stock exchanges across the country. Broadly, the securities available in the industrial or corporate sector falls under ownership and creditorship. Now, we will see what is ownership and what is creditorship. Securities under ownership may be equity shares and preference shares, whereas those under creditorship may be convertible debentures, deep discount bonds, zero coupon bonds, etc. So in order for the investor to include securities from the different classifications into a portfolio of securities, he has to first do what is called as a security analysis. Hence, security analysis is the first step in the portfolio management process. Here, risk-return characteristics of each security is thoroughly examined. In some sense, security analysis is where identification of mispriced securities are done in order to clearly differentiate between underpriced securities and overpriced securities. So that is an explanation of security analysis. Next we'll see or we'll explain the approaches in security analysis. So in short, the security analysis is performed by following two approaches, namely fundamental analysis and technical analysis. So what is in fundamental analysis? In fundamental analysis, an approach to security analysis, it concentrates on fundamental factors concerning an enterprise, namely earnings per share of a company, market share of a company, dividend payout ratio, which shows the competition that is faced by the company, as well as management or quality of management in a company. Now, a financial analysis who follows the fundamental analysis works out the true or intrinsic value of a security based on fundamental factors. If the intrinsic value is lesser than the market price of a share, the share is said to be overpriced. And if it is more than the market price of a share, the share is said to be underpriced. Remember, in fundamental analysis, the belief is that share price of a company is only determined by the fundamental factors of a company, namely earnings per share, market share, DPR, and quality of management. Now, the benefit of following this method or approach is that the mispricing of shares may lead to an opportunity where the investor can acquire or dispose shares based on whether the shares are underpriced or overpriced. And in doing so, the investor will be staunch in his belief system that the market corrects itself in the future in order to correctly project the share price of the company. In short, the fundamental analysis provides a way for the investor to correctly include shares of strong companies in its portfolio. Now, the next approach, which is the technical analysis, is where the analyst believes that there exists a systematic movement in share prices, and the share prices, in doing so, follow a consistent pattern which becomes part of its study. Hence, the technical analyst studies the past trends and patterns in share price movements and use it to extrapolate future share prices. Hence, a comparison is also made of current share price in the market with the future projected share price, and the mispricing is brought to light based on these projections of share prices. A more recent approach is efficient market hypothesis, which believes that the financial market is efficient enough to price the shares, and all the projected values from technical analysis or fundamental factors from fundamental analysis, according to this school of thought, is not required. So we have covered an overview of security analysis and wealth creation in this session. Thanks.